A reminder, if you need one, that your quiz is on Monday, the first 30 minutes of class. It'll cover everything in capital structure, which is the first part of the second packet. So it's about 20. So we'll be done with capital structure about 30 minutes into today, but it covers the financing, makes the cost of capital approach, what happens when you buy back stock, or ending through duration of debt, matching up, getting the right type of debt for your company. And I'll talk a little bit about that duration of debt issue because it comes up in every one of the third quizzes you've seen so far in terms of pure mechanics and why, if you understood the unlevered beta process and how we dealt with it, you can also deal with the duration aspect. So let's say where we left off on Monday. We were talking about the right debt for Disney, and we actually went through the macro data, interest rates, inflation, GDP, trying to get a sense of what drives Disney's numbers, right? Not just their operating earnings, but their value as a company. It's a purely data-driven approach. So rather than making subjective judgments about my company is cyclical, my company has pricing power, you let the data tell you whether your company has pricing power. So let's review. The first one, you run the regression against interest rates, you're getting a measure of the duration of your company's assets. Why? Because for every 1% change in interest rates, if your value drops by 5%, that's essentially the equivalent of having a duration of 5 years. When you run the regression against real GDP, you're getting a measure of, is my company truly cyclical? If it is truly cyclical, the coefficient you should get when you look at real GDP should be a big positive number. So when your GDP is doing well, your earnings and value should go up. If that coefficient is 0, your company is not cyclical. If it's negative, your company could actually be counter-cyclical. When you run the regression against inflation, you're getting a measure of pricing power, because if you have pricing power, inflation should show through. It should show up in your earnings, it should show up in your value. If it doesn't show up, then you don't have pricing power, no matter how much you think you might do. And then when we ran the regression against a weighted dollar, we got an answer to the question, how does a stronger dollar affect my company? Because you take a US company, a stronger dollar can help them, it can do nothing for them or hurt them. And again, it's a purely empirical question. So it's entirely data driven. And it'll work if you have a company with a long history. But what else has to be true about your company for that long history to answer those questions? So let's say you have 50 years of history on AT&T. In fact, with AT&T, you have 120 years of history. Why is much of that history useless when you look at AT&T today? It's a very different company, right? For much of that 120 years, it was a monopoly. It was the monopoly. Anybody with so sometimes you have a lot of history and it's not telling you much. Even in the case of Disney, I have qualms about using it because Disney as a company has changed so much over that 30-year period that I looked at the data. It started as primarily an animated movie theme park company. It acquired Cap Cities ABC in 96. It became this broadcasting company. Then it bought more movie franchises, Star Wars, Avengers, and then it entered the streaming business. So one of the reasons when you look at historical data, you got to be a little careful is that data can give you numbers, and the numbers that I'm getting for Disney reflect the 30-year history, but I'm not sure they're good numbers going forward. In fact, I have a second issue. If you remember, I showed you the standard errors, the t-statistics for each of these coefficients. And they were for many of these regressions, the coefficients are either not statistically significant or barely significant. There's a lot of noise in the regression, which is a nice way of saying in statistics, hey, there are lots of things I can't explain with this regression. I think we ran into this problem one time before in this class, right? Where else in this class have we used a regression to come up with the metric and then said, that's noisy, I really don't trust that number? It was here, we did betas, right? And there, what was the solution we adopted? We looked at the average beta across a lot of companies. How did that save you? It's a standard error issue. When you look at the average, you're removing the noise. You see where I'm going to go next, right? So when I computed the duration for Disney, I ran one regression of Disney's numbers against the past, and I came up with this minus 2.33. But the statistical significance of that number was non-existent. The t-statistic was less than 1. What if I could run this regression for every company in the entertainment business. That's going to be an insane amount of work, but let's say I was willing to do it. Right? And I could give you an average for that coefficient across all companies in the sector. You'd now have a bottom-up estimate of duration for the company. And because Disney is in multiple businesses, here's what I did. If this table looks remotely like another table we did, it's intentional. Remember how we got bottom-up betas? We broke Disney down into 5 businesses, and there we estimated the beta of each business. In this table, instead of doing that, I'm computing the average coefficient I got when I ran regressions against interest rates, real GDP, inflation of other companies in this business. So think of these as bottom-up estimates of the duration of Disney, the pricing power of Disney. There's stuff I lose when I do these bottom-up estimates that are specific to Disney, but there's a great deal that I gain. So if you trust these bottom-up coefficients, it looks like the weighted average. And again, the weights are exactly the same way as they were with unlevered betas. Weighted by value of the business is minus 4.34. The minus 2.33 I got from running just the Disney regression is now in the trash can. I'm going to replace with the minus 4.34. The duration for Disney's debt, roughly speaking, should be about 4.3 years if I trust the bottom-up estimate. So again, the parallels between beta and what we're doing here should come into play. We're just taking the average because it gives you a more precise number. So all you see there are the averages across all of the macro variables. They will replace the individual regression. I told you it's an insane amount of work. It's so much work. I don't update these numbers every year. And it took me an entire 2 weeks to actually run these regressions once. So I do them once every 10 years. I'm hoping to do them once every 100 years. That's why I'm one and done, because I don't think I have to do the second iteration. I won't be around. Okay. But I will send you this latest version, which was from like 6 years ago. So I don't want you to run, so when you run the macro regression for your company and you get strange looking numbers, I don't want you to spend 2 days trying to figure out why the numbers look strange. It's statistics, there's a lot of noise. Just replace them with the bottom up numbers, move on to the next part of the project. So here's the bottom line. When you look at Disney, I can tell you what Disney's debt should look like. It should be pretty long term with a duration of roughly 4.3 years. The 4.3 comes from the weighted average bottom up. Okay? A significant portion of the debt should be floating rate debt. I won't even specify what percentage because there's no easy way to do it. Why? Because it looks like Disney has pricing power. And intuitively, I think it does. I do think that given how that Disney's earnings and value are sensitive to the US dollar, a portion of the debt should be in non-dollar currencies. And if you look at the geographic breakdown, maybe that'll give us a lead. In 2013, it was 82% US, 18% the rest of the world. Today, it's about 70% US, 30% the rest of the world. I would like the debt to match. So I have a sense of what Disney's debt should look like. And then I open up Disney's balance sheet. And what am I going to see there? I'm going to see what Disney's actual debt looks like. Disney in 2013 had $14.3 billion in interest-bearing debt with a face value weighted maturity of about 7.92 years. If you remember, the 7.92 years was what we used to get the market value of the debt. Basically, I need to have a duration of roughly 4.3 years. The maturity is 7.9 years. I can't compare maturity to duration. Why is that, Franz? Why can't I compare maturity to duration? Because you get coupons over the life of a bond, right? So when you look at maturity, it's going to overstate because I'm going to get a coupon in year 1, 2. So when I have a maturity for a bond of 10 years, its duration will be lower because I coupon. So the 7.92 years has duration of roughly 6, maybe 6.5 years. So it looks like my Disney debt is a little too long term, but not a huge difference. It's not like 17 versus 4. It's about 6 versus 4. Of the debt, about 5.5% of the debt is in non-dollar currencies, primarily in Hong Kong dollars because they funded the Hong Kong theme park with Hong Kong dollar debt. That looks too low to me. Why? Because I know that 18% of their operations are outside the US. The 5.49% looks too low. So I'm adding up ammunition on what I think Disney should do differently. Slightly more short-term debt, more foreign currency debt, and about 5.6% of their debt is in floating rate debt. And that too looks like it's too low given the pricing power Disney has. So I have my recommendations for what their debt should look like, what their actual debt looks like, and I can see a mismatch. It's not an immense mismatch. This is not exactly something I have to go fix right away. For some companies, the mismatch can be so horrific, you can say, you know what, I've got to do something right now because this company has a mismatch problem. Take Baidu, 80% of their debt is in foreign currency. All their revenues are in Chinese yuan. So the first thing I'm going to check with the companies, have you done something about it? And they might have, right? What could they have done to fix a mismatch? Wait.
They could have taken out swaps.
They could have done swaps. So show me evidence that you're doing something that you know there's a problem. Because if you say, what problem? Then I have a problem with that, right? So if you know there's a problem, you've done something. So if you see a mismatch, that's the next step, is before you jump and decide the company has a problem, check to see if they're aware of the problem and they're doing something about the problem. In this case, there's a mismatch. It's not huge, but if I wanted to fix it, here are my choices. I can swap some of my debt to make my overall debt look better. What does that mean? Remember, I want my debt to be less long term, more foreign currency, and more floating rate debt, right? So here's what I'll do. I'll take some of my fixed rate dollar debt, preferably long term, and swap it for floating rate euro debt, which is more short term. Essentially, I'm fixing my debt by replacing some of my debt with debt that better suits me. Right? I can use derivatives, options, futures to kind of manage that risk. Try to make my, I mean, the levers you have today to fix essentially a mismatcher are far more powerful than they'd have been 50 years. 50 years ago, you'd have to repay debt and replace them with new debt. Today, you don't have to do it. So I can I can use swaps, I can use derivatives, and there's a third factor here to consider. Disney is still growing, it's still investing. Its next theme park at that time is already talking about is going to be in Shanghai, a really expensive theme park, and they have to finance it, right? So when they ask me how should you finance the Shanghai debt, first I'm going to suggest more short term than they typically use because I want the overall debt to become more short term, preferably in a foreign currency because I want more foreign. And if you can make it floating rate debt, even better. So you can take the next debt issue you make and effectively use it as a way of kind of fixing that mismatch between where you are today and where you'd like to be. In much of the world, mismatches are embedded. They're baked into companies' balance sheets because of their history. 20 years ago, if you are not a US company, when you wanted to borrow money, guess where the debt came from? You're an Indian company, an Indonesian company. You borrowed from a bank, usually a local bank. And when you borrowed from the bank, what was the structure of the debt? Whatever the bank said you could borrow at. So everybody borrowed a 10-year fixed rate debt because that's what banks would lend at. So it's not that these companies were not savvy, they just didn't have the choices. And a lot of that debt is still on their balance sheet. So before we get fancy about financing mix and changing the debt of a company, this is a much simpler fix to make now. Is an Indian company today has choices it did not have 20 years ago. So when it has debt that's 20-year fixed rate debt, but its basic business says you need floating rate foreign currency debt today, you can make that choice and fix it fairly quickly. So I would start with that process. So what I'd like you to try to do with your company is before you look at the balance sheet, think about intuitively, what kind of debt would I expect this company to be? Long-term or short-term? What currency, fixed or floating rate? Make that choice first. Then look at the debt on the balance sheet and does this debt make sense for my company? I briefly mentioned that in the last session, that the debt you see in businesses often reflects what's right for that business. In retail, a big chunk of the debt you will have for your company comes from leases, right? How do leases match up? You basically, your assets are stores. What does a lease do? It matches the debt up to the store in terms of location, in terms of life, in terms of, and in fact, if the store does really badly, in many cases, on that individual lease, you have escape hatches you can use. Leases are the right debt for most retailers because they reflect the way you grow, the way you invest. So when you look at your company, that's what you're looking at is the kind of debt that I have, the kind of debt I would expect to see in this company. And then if you see a mismatch, you can't fix it obviously in a project, but you can say these are some of the things they can do. They're a growing company, they're taking projects. On the next few projects, I would suggest they take this type of debt to get back to a match. Now, for my other companies, I'm going to be briefer in terms of the debt design because clearly by now you can see the process, right? You can work through. In the case of Bookscape, a retailer in New York. I think the kind of debt they have right now is lease debt. I think that matches up to what they should be having, given their location, their currency, the type of assets. Vale, it's mostly mines. That's what you're financing with your debt. The mines tend to have very long lives. And they're all over the world, right? You have Canadian mines, you have Brazilian mines, you might have mines in, I don't know, parts of Asia. So when you look at the kind of debt, it should be long-term debt. And here it should be dollar denominated for the most part, no matter where they are in the world, for a simple reason. Commodity companies live, at least for the moment, still in a dollar denominated world. The markets are dollar driven. So with commodity companies, it does make sense that no matter where you are in the world, you try to use US dollar debt. Okay? Their actual debt is primarily US dollar debt with an average maturity of 15 years. It was the company with the longest maturity. At least in a very rough sense, that does make sense for Vale. For Tata Motors, it's a manufacturing company with one very big external arm in the form of Jaguar Land Rover. I would expect that to be very different for the mass market Indian automobile business as opposed to the luxury auto business. They have very little pricing power within India. So when they issue debt to fund that business, I would expect to be fixed rate debt, preferably long term in rupees. But for Jaguar Land Rover, they have more choices. It clearly should be foreign currency. Perhaps there's more pricing power there, which gives you floating rate debt. So choices become richer. The existing debt for Tata Motors is a mix of rupee and euro debt with an average maturity of about 5 years. So, I mean, it doesn't look off. It looks pretty close to what you'd expect it to be. They don't have any floating rate debt. I would expect them to have a little bit of that. So maybe that's the one change you'd expect. Baidu is the one company in my mix, at least, that had mismatched debt. That was dramatically mismatched. No, I would expect the debt to be in Chinese yuan. And because it's a growing company, it's the kind of company that should be using convertible debt because the variance, the risk actually works in their favor. They have no convertible debt. It's all straight debt. So maybe they know there's a problem, but there was nothing in the financials that I saw that told me that they were using any kind of swaps, but they don't have to. It's not something that you have to disclose necessarily because it's part of your, day-to-day, month-to-month operations. But that's a question I would ask them. What are you doing about dealing with this mismatch between the fact that all of your operations are in yuan, but your debt is a foreign currency? So before I start on dividend policy, I want to talk a little bit about that final problem you have on every one of your third quizzes going back probably 20 years. It's a problem that deals with this debt mismatch question. And it's usually about the duration of the debt. Right? So all of these problems will start with an existing firm. An existing firm is in businesses, it has a certain amount of debt. My suggestion is the same one that I made when I talked about beta. Start with the equivalent of a balance sheet, right? You have assets, you have liabilities. Start off by looking at what businesses is this company in and asking what is the duration of those businesses. So usually the problem will specify this company. So let's make up a problem. And it'll give you kind of a window into how I write these last prompts. So let's take a company. Leon, help me out. Put the company in any two businesses you want. Any two that you want. What's EDP? ADP. Oh, two companies. No, two businesses. Yeah. Like steel and chemicals or, yeah. Steel and farm. So you're in two businesses, and I give you the duration of each of these businesses. How did I get the duration? Maybe I did the bottom-up durations for companies in the business. So let's say the steel business has a duration of 10 years, and the pharma business has a duration of 25 years, right? And I'll tell you how much value the company gets from each business. That'll be given in the prompt. So let's say it gets 800 million from pharma and 200 million from steel. So 800 times, so the duration is a weighted average, just like betas are. So you have a weighted average duration of the businesses this company is in. So the problem gives you that. Then I'll also tell you how the company is funded right now. I'll say right now, because you have what 20, in this case, the collective value of the assets and the liabilities, I have to say 80% of your value is in equity, 20% in debt, and I'll give you the duration of the existing debt. So the problem always starts by specifying what the company looks like right now. So draw the duration, balance sheet should have duration of the assets, duration of the debt. The second part of the problem always follows a script. Something happens at the firm that changes the asset side. Like what? You do an acquisition. Why does it change the asset side? You're bringing a new asset with perhaps a different duration. So this company decides to enter the AI business. Why? Because everybody else is entering into it. You have no idea what the business is, but you spend some money getting into it. And I give you the duration of that new business. First step in all of these problems is work with the asset side. Remember how with unlevered betas, we always work with the asset side? Take the unlevered beta of the new business mix this company is going to have. And usually the problem will specify how I fund that change. So in the case of an acquisition, I'll say, I'm borrowing the money to fund the acquisition. And here's where the question that the problem will ask will come into play. The question in the problem will be, what will the duration of the new debt have to be to get the duration of my debt to be equal to the duration of my assets after the acquisition? So you do the acquisition, you compute the new duration of the assets. You have the existing debt with the existing duration. You're taking on new duration, and I'm asking you what the duration of that debt should be. That's the X in your equation. You solve for it. Every single problem will follow that script. So if you see twists, it'll always be around those. What can the twist be? Instead of acquiring something, I could divest a portion of an existing business, right? Why will that change duration? Because the weights will change. So if I'm divesting myself of half of one of my businesses, the duration of my asset side will change. Then I'll have to tell you what the cash is used to do. Maybe I'll buy back stock or retire some of my debt. And the question might be, how much of the debt will I have to retire to get the duration to match up? So focus on what's happening before the change, and then look at the effect of the change on the duration of the asset and the duration of the debt. Exactly the same framework we used when we thought about betas, but now we're using it to ask what's the right duration of my new debt. So now let's talk about the third and the final piece of corporate finance. Right? Before we start the discussion of dividend policy, I'm going to make a statement about cash and dividends that I think will animate how we think about dividends. You're a shareholder in a company, let's say Apple. How much cash does Apple have? Lot, right? 200 billion. But let me reframe that. Apple has no cash. It's holding your cash, you being the shareholder's cash. Companies have no cash. What you see as a cash balance is shareholders' cash. It kind of changes the entire framework for the discussion, right? Because when you show up at an annual meeting, what do you have to do right now? You got to beg the managers to pay you a bigger dividend. Beg the managers to buy back more stock. Why? Because managers at companies seem to think the cash belongs to them. And you're interlopers who show up asking for dividends and they give you a little dividend. You're supposed to go away. The truth is, if this were a fair universe, you know what managers in every company would have to do every year? They'd have to get up and beg you to leave your cash with them every year. Unfortunately, we don't live in that world of corporate governance. So we're going to look at cash return from the framework of, hey, what should shareholders expect to see from a company? And when a company chooses not to do that, what happens at the company? And what can you as a shareholder do in reaction? So there are two basic questions I'm going to try to answer in the next 2, 3, maybe even 4 sessions. First is, when you look at a company, how much cash can a company how much cash can a company return to its shareholders? Your first reaction might be, well, it can return its earnings as dividends. Well, that's not necessarily true, right? Wade, why not? Why can't I return earnings as dividends?
Earnings are calculated on an accrual basis, so it may not reflect the actual.
First, earnings are not cash flows, right? You can have a company with billions of dollars in earnings and not. Even if earnings are cash flows, why can't I return the cash?
You need it to grow the business.
Exactly, right? So earnings are not what you can afford to pay out. It's the cash left over after you've covered the needs to meet future growth requirements. So we're going to have to estimate what that cash will be. It's surprisingly simple to do. I'm going to, come up with a term called free cash flowed equity, which is essentially cash left over after you've met every need. And we'll talk about what that cash flow will look like over time. The second question I have to ask, and it's become an increasingly critical question, is in what form? When I started teaching corporate finance, this is the early 1980s, 1983, 84 was my first corporate finance class. Very few firms bought back stock. If you were returning cash to your shareholders, it's usually in the form of dividends. And in much of the world, this still remains true, right? But in the US, increasingly, you have two ways of returning cash. You can either pay it out as a dividend or you can buy back shares. And I think that choice has been complicated by people bringing in distractions about both items. So I want to talk about, hey, which one is the better choice? What is the trade-off you have to think of as shareholders as to why you might pick one over the other? So let's start this discussion by looking at how dividends would be set in a rational universe. What's the definition of equity? When we talked about equity versus debt, debt has a contractual claim. You remember what equity's claim? What was the equity claim? Residual, right? Which basically means you get whatever's left over. So if the universe were a just universe, you ran businesses with that in mind, your dividend should be the last step in the process. You're looking at what's left over. It should come after you've done all of the other stuff in the company. Start with the earnings, you cover your operating needs, your capital expenditures, your working capital, your debt payments. Remember all of those, and what's left at the end should be what you pay out as dividends. And if that were the case, your dividend should swing wildly from year to year, right? Because it should be low in bad years, high in good years, should be zero when you're having a negative cash flow year. Already you can see that that is not the way the universe works. The way companies pay dividends, it doesn't look like it's a residual claim. How do we know? For most companies, when you look at the dividends this year, what do they look like? Dividends last year and the year before and the year before. This is not how a residual claim works. So if you look at dividends, I think you see the essence of it's the most dysfunctional part of corporate finance. Dysfunctional, what sense? Well, a lot of companies, when you look at what they pay in dividends, it doesn't reflect any kind of residual cash flow. It's fixed, it's rigid. You say, why do they do what they do? The two forces that seem to drive how much companies return as dividends is inertia. Inertia reflects what have we always, many companies actually boast about the fact that they've paid dividends for the last 142 years. There's a bank out there that's paid dividends for, congratulations, you've broken every rule in what dividends is supposed to be, but it becomes, we paid dividends for 142 years. ChatGPT must be running your company, right? Because you say, how much should we pay in dividends? You look at dividends last year, you paid out this year. The other is Me too is it. Why do you pay what you do in dividends? Because everybody else in our peer group also pays dividends. You're a bank. It is very difficult to be a bank that doesn't pay a dividend because every bank seems to pay a dividend. So in the real world, dividends don't always reflect that residual claim. They're often set for reasons that have nothing to do with what the company can pay. So I'm going to start by listing out some facts about dividend policy based on the data. And this comes from our discussion so far. If you ask me to use one word to describe dividends in the US, and I'll talk about the rest of the world as well, the word I would use is sticky. Okay? Let me back that up. In this graph, I have the number of, or the percentage of US companies each year that increase dividends. That's a green column. The percentage of US companies each year that cut dividends. That's a red column. If I pause right there, you can already see the mismatch, right? Far more companies increase than decrease dividends, about 3 to 1, 4. Even in really bad years, 2009, 2020, more companies increase than decrease dividends. But in every single year, the percentage of companies that pay exactly what they did last year outnumbers companies that change dividends. It's the sticky part. Most companies pay out what they did last year. So if you take your company and it pays dividends, look at its history on a per share basis because it's sticky on a per share basis. 25 cents per share, 50 cents per share, because that's what we've always paid. This is true in much of the rest of the world, but it depends on what part of dividend policy is sticky. In Latin America, rather than pay sticky dollar or absolute dividends, it's sticky payout ratios. A certain percentage of earnings gets returned every year. The reason for that is in much of Latin America, you have these voting and non-voting shares. The non-voting shares are triggered by not paying out a certain percentage. So they get voting claims if you don't pay out 30% or 40% of earnings. So it's almost locked in. So in much of the world, dividends are sticky, which cuts against a residual claim, right? In a residual world, dividends shouldn't be sticky, but they are. Second, so even in 2020, terrible year, 287 companies, increased dividends, 11 cut dividends. And the 11 that cut dividends made history. That's an unusually large number in the S&P 500 to cut dividends in a particular year. You know, of the S&P 500 companies, 27 increased dividends and 42 suspended dividends. You know, I think this was in the second quarter of 2020. So basically, you see that even in bad quarters, companies continue to pay what they did in dividends. Extraordinarily sticky. Second way to describe dividends, they tend to follow earnings. Keyword is follow. They don't lead earnings. They're not contemporaneous. So here's dividends and earnings over time. It's tough to read the columns, but basically you can see the payout ratio is kind of moved all over the place. But over time, the red column almost never decreases on a year-to-year basis, but earnings have good years and bad years. So if you have a company that has a good year with earnings, I wouldn't expect dividends to go up this year. There's 2 good years, maybe it'll go up next year. If it's 3 good years, then you might see dividend increase. Managers seem to wait to increase dividends. In fact, take the 2 parts that we've had so far, sticky, where more increases than decreases, and the fact they follow earnings, you can see why the 2 kind of go together, right? Managers tend to be cautious about raising dividends unless they feel they can sustain them. So when they cut dividends, it's often uncommon. Something bad has happened at the company. But the third graph is also something worth remembering. Who gets all these dividends? It's shareholders, right? Who are the shareholders in a company? They can be institutions, but those institutions hold shares. Remember, when a mutual fund gets dividends, it comes to you. So you will get a tax statement at the end of the year from the mutual fund telling you how much you received in dividends on your mutual fund. So it flows through. It could also be institutions like pension funds that are investing. So it could be institutions, it could be individuals. Some of them can be tax exempt, some are taxable. But taxes play a key role in thinking about dividends. Because as individual investors look back through history, the tax rate on dividends for much of the US income tax history was much higher than the tax rate on capital gains. Does anybody know when income taxes were instituted in the US? It was actually a little bit after. The Supreme Court actually had to rule on whether you could have a federal income tax, and it was 1914 or something that you actually see it kick in, right? So 1914, you get tax laws, and basically, early on, all income was taxed at one rate. So it was like 5% was supposed to hit like 2% of people, and they paid 5% of their income. And over time, both those numbers increased, so higher percentages paid taxes, and the tax rate changed. Somewhere around 1920, there was a second tax rate created for capital gains. Capital gains would be, what you made on your investments and you held them long term. I think early on that was set at a 1-year threshold. And for much of the 1900s, you had two different tax rates, one for ordinary income, 30, 40, 50, or even 70%, and one for capital gains at a much lower rate. In fact, when Ronald Reagan was elected president in 1981, the highest federal income tax rate on ordinary income was 70%. The capital gains rate was 28%. So let's play it through. If you receive dividends, it's treated as ordinary income, and that's what it was for much of the 1900s. You were taxed at 70% on that income. If you got price appreciation on that same company and you sold the stock, you got a 28% tax rate. This seems like a no-brainer, right? I mean, who wants to get dividends and get taxed at 70%? There are people who still chose to, because not everybody got taxed at 70%. That was the highest tax rate. Maybe there were people who were not paying taxes on income and said, I'd like. So already you can see taxes are going to play a key role in whether your shareholders want dividends or not. If your shareholders are all very rich people, they're probably going to say, I don't want the dividends. I'm getting taxed at 70%. That divergence between what ordinary income was taxed at and dividends was classified as ordinary income, and what capital gains was persisted till the 2003 or 4 Tax Reform Act. And for the first time in US tax history, the two, dividends and capital gains ended up with the same tax rate. So starting in 2004, US companies have been, if you receive cash from US companies, either in dividends or in long-term capital gains, your tax rate has been roughly the same. It was 15% in 2004. It went up to 20% after Obamacare. Medicare taxes actually attached to this income as well. So right now, the tax rate on both dividends and capital gains in the US is about 23.6% for long-term capital. If you have short-term capital gains, it's treated as ordinary income. So that portion of income actually gets taxed at a higher rate than everything else. But dividends and long-term capital gains are taxed about 23.6%. Last week, I saw a rumor or a news story, or maybe Trump saying that he would plan to bring the capital gains tax rate down to zero, which will open up that difference again, right? But for the moment, they're taxed at the same rate. But US tax reform acts have this very strange cliff built into them because of how the Senate passes these tax bills. The Senate, as those of you who follow US politics know, has a filibuster. What a filibuster started with the senator getting up and they can talk and talk and talk. But over time, it's evolved that you need 60 votes to get anything of consequence passed in the Senate, which means nothing will get passed, right? Because it's very difficult to get to 60 votes. Obamacare passed because it was a very brief period where you got to, I think the Democrats at 60 votes for 2 years before the thing blew up. But you almost never get to 60 votes. But there's one exception every year, which Congress uses to pass tax reform acts. It says loophole, I won't even call it loophole. There's one opening called a budget reconciliation where you can get 51 votes and get things of consequence passed. Everything of consequence in the last 15 years that's changed has come through that budget reconciliation. But it comes with a catch, which is you're allowed to only pass things which are budget neutral in the long term. Nothing Congress does is budget neutral, so they have to do all kinds of gaming. And one of the gaming that they do to get tax reform passed is they make it a 10-year window, after which what happens? The tax law reverts to what it was before, but it's a trick which essentially says it's only 10 years, so this is not permanent, so the tax loss we will not have is not that great. And that effectively allows every tax reform act to be passed. And it creates a consequence, right? You have a tax reform, everything changes, but only for 10 years. And at the end of the 10th year, what happens? You fall off the cliff. You go back to the old tax law. So one of the things that you see often happening is as these tax laws are going to shift, you start to see people, companies, investors reacting. So this is, just ahead of the Bush tax reform in 2003. So as you see tax rates on dividends come down, you see the dividends increase because you have a lower tax rate. But then you get to 2013, you approach a cliff, and everything is going to revert back to the way it was before 2004. Investors now have to reassess. We're approaching another cliff. The 2017 Tax Reform Act, which effectively lowered the federal tax rate to 21%, changed the tax code on interest payments, is set to, I think, to go off the cliff at the end of 2025. So if you talk about budget reconciliation this year, part of it is going to be about extending that act another 10 years. There's almost certain that it's not going to be permanent because you don't have 60 votes, you have 51 votes to get there. So that's part of what you're going to see play out. So in the US, every 10 years, you go into this game of everything could change in 3 months. What do we need to do? I'll wager that if you'd had a different outcome from the November elections, we'd be approaching a cliff that almost certainly would have seen a big change in tax rates at the end of this year, right? And investors and companies have to adjust. And you see dividend policies reflecting that. The last quarter of 2012, as that previous Tax Reform Act was approaching its cliff, where dividends, you could see the tax rate and dividends bounce back up. Companies paid out huge amounts in special dividends in that last quarter, saying this could be the last quarter where dividends get taxed at a lower rate. Now, Las Vegas Sands paid out, I think, a $3 billion special dividend, 52% of which went to Sheldon Adelson because he was a 52% shareholder. So it wasn't something underhanded in terms of what he got. But basically, the special dividend was paid out because people were afraid that the tax rate on dividends would go back up to an ordinary income tax rate, 40%, 42%, 44%. So one of the things to watch this year, especially if there's going to be a change in the capital gains tax rate, is what happens in terms of people. Because let's play it out. Let's assume that part of this package is the capital gains tax rate goes to 0%. What's going to happen? You're going to probably see a lot less paid in dividends, fewer trades at the end of the year on stocks that have gone up a lot because you don't want to catch again. And in the first month of next year, you're going to see a boom in trading on those stocks. So you can almost, if you're a trader, there's a whole host of things you can try to do to take advantage of that. So do tax laws matter? Absolutely, and especially so with dividend policy. Now, here again, I want to bring in the rest of the world. In the US, through much of the last century, dividends were taxed at a much higher tax rate than capital gains. That difference has gone away. But in every country, the laws are different. In Switzerland, the laws are actually different in different parts of Switzerland. Each canton has its own laws on dividends and capital gains. One of the things I would encourage you to do if you have a non-US company, an Indian company, a British company, an Australian company, is look at what the tax laws to individual investors, this is not about companies, what are the tax laws on individual investors when they receive dividends as opposed to selling shares and collecting capital gains. I'm familiar with the UK and the Australian laws at least. In the UK and Australia, if you're a shareholder in a company and you receive dividends, you know what you're allowed to do? Does anybody know? You're actually allowed to claim a tax credit for taxes the company has paid already on income from which the dividends are paid. Let's play it out. Let's suppose you have $100 million in income. You have a 25% tax rate, right? Remember, dividends get paid out of after-tax income. So you take the 25% tax rate, you have $75 million after taxes, your taxes after it. And let's say you pay the entire 75 million out as dividends and you receive a dividend. Let's say your tax rate is 30%. Normally, when you receive a dividend, you have to pay 30% of that in taxes, but in the UK and Australia, you're allowed to claim the 25% that's already been paid in taxes as a credit, which means effectively on dividends, you get this really low tax rate or a zero tax rate if your tax rate is less than the corporate tax rate. The UK and Australia also have some of the biggest dividend paying companies in the world. Why? Because you've got a tax law that essentially makes dividends tax exempt, but capital gains are still taxed. There are other parts of the world where capital gains are not taxed for lots of different reasons. I want to encourage people to invest in equity markets, and dividends are taxed. So take a look at the tax code within your country, and I'll send you a couple of links if if you want one place where you can go look it up, because it will affect how much companies pay in dividends. So dividends are sticky, dividends follow earnings, dividends are affected by the tax code. And there's a fourth and final piece of this puzzle. And this is, I think, the biggest shift in dividend policy that I can point to that's happened mostly over the last 4 decades. As I said early when I started teaching the class, most of the cash returned by US companies took the form of dividends. In fact, in 1981, 98% of the cash returned by US companies took the form of dividends. Buybacks were rare, and they were designed for a very different reason. Starting in the mid 80s, that started to shift. So this graph actually starts in 1988, but even in 88, early in the process, twice as much money, so the green is the dividends, the red is the stock buybacks, twice as much money was returned in the form of dividends than buybacks. And I've tracked that over time. Clearly, there are some ups and downs, but you can see during the 1990s, buybacks start to explode. And in 1998, for the first time, 1998, for the first time in US corporate history, more cash was returned in the form of buybacks than dividends. You think that's .com. But it's really not gone away. In fact, if you look across time, that red column consistently, I think, even except for 2009 where it dropped off, and and that should become part of why buybacks have taken off. Every single year buyback, and last year, 2/3 of the cash returned by U.S. companies was in the form of buybacks. $924 billion got returned in buybacks, about $650 billion in dividends. This is no longer something that's going to pass. This is clearly a long-term shift in how companies return cash to their shareholders. So I have a basic question about, let's focus on the US. Clearly, this is happening. Why do you think companies have shifted away from paying dividends to buy? And every answer you give, I'm going to pass through the test of, hey, can this explain what happened before 1990 as well, right? Because if your reason is this is why you see the shift, I'm going to say, well, if that's the case, then why didn't you see more of it before? So why do you think companies have shifted away from dividends to buybacks? No, you must have some hypotheses. Throw it out there and we'll kind of drag it through the process. Why do you think companies have shifted away from dividends to buybacks? Yes, Kelly. They're not committed to it. Okay. So why didn't this apply before 1990? Why were we willing to commit before 1990, but we're not willing to commit in 2021 or 2022? It's always been true that dividends have been sticky and buybacks are easy. So why did people suddenly wake up to that in 1985 when they had that choice in 70? Nothing in the law has changed. You've always been able to buy back stock, but something seemed to trigger that switch of, hey, we can buy back stock. So let's file that away. So it's clear dividends are less require commitment, buybacks don't, but that's always been true. So why is that more of a factor now than it was 40 years ago? But let's look to some of the other reasons that get thrown out for this as well. What else can explain dividends buyback? Could it be tax code? Tax code actually pushes in the opposite direction, right? Because remember I told you that until you get to 2004, dividends were taxed at a higher rate than capital gains. Dividends at a disadvantage. If taxes were your reason, you should actually see more dividends now and less buybacks because the tax reason for not paying dividends has kind of gone away. Anything else that might have changed? There has to be something that changed at companies, right? Kelly, ever something else that might have changed at companies that explains this?
I'm just thinking like more recessions and everything, and firms don't want to be stuck to paying these dividends. Maybe they had negative.
More recessions. Actually, there have been fewer recessions in the last 34 years than before, right? Recessions have actually become more infrequent rather than more frequent. This one clue is, when did it start? 1990s. What kinds of companies entered the market?
Has to be with like tech companies that look forward to increase, like they focus more on increase the value of the companies rather than returning capital.
That's a very dangerous follow-up statement. Everybody wants to increase the value of the companies, right? So in a sense, it's not just tech companies. But there is a reason there's something to do with tech companies and how they.
I guess they're all public. I was going to say for some of the smaller companies, people want to get out of those shares, but maybe don't want to.
Compensation. Let's make that about share. So if you care about share price as a manager because you're compensated better based on share price, you have options as part of your compensation package. Remember what dividends do, right? The minute you pay a dividend, your stock price drops. You're saying, I'm going to be focused. So it's not just value, it's per share price that you care about because your compensation is tied. Early on, that was the reason given for this surge was in the 1990s, you have a lot of tech companies paying people with options. They care about the price. So given a choice between paying out dividends and buying back stock, they're going to buy back stock. But here's the problem with that reason today. First, today, if you look at how companies pay their employees, they pay them with restricted stock, where you get dividends on those stock. Now, 90% of stock-based compensation now is restricted stock, only 10% is option-based. Second, when you look at who buys back stock, it's across the board. It's not just tech companies, it's every company in every sector, small companies, large companies. So it might have been started by the share price fixation at companies and management compensation, but that reason seems to have dissipated. Not taxes, but I think Kelly has two of the parts of what go into the right answer. First is, she said the dividends require commitment, buybacks are more flexible. And the second part, she talked about not just recessions, but economic uncertainty. In my piece on globalization, I talked about the good side of globalization, right? We all have more choices. Companies can expand anywhere they want. But there is a flip side of globalization, which is it's made uncertainty about your business greater across the board. Why? Because you no longer have nice local markets you dominate, not have to worry about competition because before you know it, a Chinese company can make things at half the price you made, and there goes your nice predictable market. I'll wager that 40 years ago, if you're listing out 200 companies with nice predictable earnings, you'd have had no trouble coming up with that list in the US or even in much of the world because you had companies that essentially dominated domestic markets, had predictability, and especially in the US, which had the most predictable mean reverting economy, you felt pretty comfortable about your future, not just about earnings today, but about your predictable earnings. You were willing to make that commitment to pay dividends because you felt that your long-term earnings were secure and pretty predictable. You'd have trouble finding, I was going to say 10 companies, but one company today that feels that the future is predictable enough that you're willing to commit to making a payment that you have to make every year. The world has become a more uncertain place, and as it becomes more uncertain, it becomes more and more difficult to go out and say, I'm willing to pay $5 in dividends this year and every year forever. I'll give you the analogy and it might be a little off-putting, but hang in there with me anyway, of why I think dividends have been displaced by buybacks and why this isn't going to change. My daughter turned 30 over the weekend. She's also pregnant, so she's a lot of big things coming at her. She's due in 4 weeks. But I remember when she was 7 years old, age ago, and I had to drive her to a birthday party. Get in the car. She was tiny. She was like 55 pounds even at 7 years old. So she still had to be in a car seat. She's strapped in. And she demands that I change the radio station. I listened to jazz and she thought it was whiny. So she said, I want to listen to the Z100. So I turn on to Z100. And I think they play the same song over and over again all day long, like different versions of the song. And between every third or fourth song, the DJ comes on for the patter where they talk to each other. They talk about hooking up. See how disconnected you get after 30 years of marriage. I had no idea what they were talking about. And my 7-year-old from the back seat starts to explain to me what hooking up is. Part of me is in shock. And the other part of me, the way she was explaining was very disjointed, but I kind of got it. Right? But the other part of me says, this is a great way to explain why companies have moved from dividends to buybacks. How many of you are married? Okay. Remember the marriage vows? In good times and in bad, through bad, I've forgotten. I'm terrible. I actually cannot remember any lines. No, but yes, marriage, you're for the rest of your life, right? Hooking up is nice today. I would see you tomorrow. I don't even remember your name. Companies don't want to get married anymore. Investors don't want to get married. Dividends are like getting married. Buybacks are like hooking up. Companies are hooking up. That's basically what they're doing. Nice, 3 billion, good year. Don't expect this next year. I won't even remember who you are, but that's okay. The world is shifting, and you're seeing this in both, on both sides. It's not just companies. Investors don't have any loyalty to companies. It's not, I mean, my parents have shares in their portfolio. And I asked them, how did you get this? I don't remember. Happened in the 1960s. It's still there. He said, I don't touch things there. It just stays there. That's no longer the case. Investors move in and out of stocks, companies essentially, and I don't think this is going to shift. It reflects a very changed universe of the relationship between companies and investors. And I think, legislators are a little concerned about buybacks. We'll talk about good and bad reasons to be concerned. So last year, what did the latest budget reconciliation bring in, especially for buybacks? There's something that was added to the tax code last year, specifically directed buybacks. Do you remember? You're a company that buys back stock now. You have to pay a 1% tax just on the buyback amount. It's not stop companies, they're still paying it out. But that 1% can become 5, 10, 15, 20, 50. It's essential. And in fact, this might be a good point to stop and ask, why are legislators worried about buybacks, but they don't seem to be concerned about? They both take cash out of the company, right? So what is it about buybacks? Give me the bad side, the side that says, look, there's actually a group of people who think buybacks should be bad, that they're bad for companies, bad for the economy. So can somebody play the role of, why buybacks should be banned? What is it about buybacks that troubles people and leads legislators to put a tax on buybacks? Slows investment, right? Basically, money that's bought back is not invested back in the company. And that's bad, right? Is it? Do we want GM to be investing more money back into its business? Why? You think it's good for the economy. Is it, again, good for the economy? There are all these assumptions we make, right? Companies investing more is better than companies investing less. We know that's not true already because in this class we talked about when investments add value and when they destroy value. And if you take investments that earn well below your cost of capital, you're destroying value. Why would I want those companies investing back? You see, it grows the economy. Therein lies the second worry about buybacks, that somehow this money is sucked into a giant vacuum and it kind of disappears. Where did the $924 billion that was used to buy back stock last year go? Into somebody's pockets, right? What did they do? Stupid things like pay bills. But that was only a small portion. Most of it went back where? Into the market, into other companies. The money that is used for buybacks doesn't disappear from the investment pool. It gets reinvested by somebody else. So instead of GM investing your money, NVIDIA invests your money. That's basically what. So the question here is not do buybacks reduce investment, it's who makes the investments. By banning buybacks, you're going to get companies essentially investing money across the board. But many of these companies will be investing in businesses that are businesses that really have no escape hatch, no future. I think, in fact, buybacks are healthy because they move money out of companies that don't have a use for the money, at least a good use, into companies that don't. Now, take away the last month, the last few months. If you look at the last 20 years of what's happened in equity markets around the world, I mean, clearly equity markets like China have risen, India have risen. Europe and Japan, in terms of market cap, have become a smaller slice of equity markets. But there's one market that's actually started as a big market, has become even bigger, and it's the US. It started at about a third of all US equities 20 years ago. It's now 50% of global equities. And it's not because old US companies have held the fort, right? They've shrunk. But what you have are companies like Facebook, 13 years old, is a very young company, but it's worth more than $1.5 trillion. And one of the reasons I think the US has been able to kind of fight off that aging effect is because buybacks have shifted cash within the US from older companies that have no use and allowed the funding of younger companies that have essentially taken up the slack. Europe has had much tighter restrictions on buybacks. They have a whole host of other issues. They have much tougher restrictions on buybacks. And you look at the European equity markets, take a look at the 100 largest European stocks in terms of market cap. Tell me how many young companies you find on that list. Hardly any. So when we talk through this legislation on buybacks, we can talk about when companies shouldn't be buying back stock. I do think Boeing bought back too much stock, especially in those years leading into this crisis, because they could have very well used that cash now to kind of recreate or come back with credibility, create a new aircraft. So do companies sometimes buy back stock when they should be? Absolutely. But you could say that about almost every corporate action. But to have a blanket limit on buybacks, I think is dangerous because it leaves cash in the hands of businesses that really don't need that cash, don't have a good use for the cash, and now you're going to make them invest that cash. So if anybody says it's better to invest than not invest, not true. I don't want more Bed Bath and Beyonds around me. I don't even think I want more Chipotle's opening up, and I definitely don't want 10 more Starbucks in the 6-block neighborhood I'm in, right? We don't want some companies to invest more. We want other companies to invest more. And the only way to get capital across quickly is to have the companies that have too much cash return the cash, and then that cash gets reinvested. So as you watch the debate about buybacks kind of play out, watch for all these false premises on which these debates are, based. That buybacks essentially take cash out of the market. No, they don't. They just move cash around. That they cause a drop in investment. No, they don't. They cause a different kind of investment. And if you don't like it, have a policy statement about why you think tech company investing is worse than retail company investing, opening stores. And let's hear it out. Let's play that debate out because that's really the debate we should be having. As I said, in the 80s, buybacks were rare in the US. They've taken off. And for a long time, the US was unique. Most other markets stayed with no buybacks. But it's clearly a phenomenon that is going global. So this is in 2024, I've listed out by sub-region. So small Asia is Asia without India, China, and Japan, Latin America, and the Caribbean. So if you feel that I've somehow insulted your country by putting it in the wrong region, I am truly sorry. I had to put it somewhere. Okay? So for instance, Australia, New Zealand, Canada, China. So essentially, I've tried to break it out by market size. There are the number of firms within each market, the percentage of companies within each region that pay dividends. See, Chinese companies, 77% of Chinese companies are dividend payers. The total dollar dividends paid and the dividend yield. We're going to come back and talk more about dividend yield, but what's the definition of a dividend yield? What do I divide dividends by to get dividend yield? That's payout ratio. Net income would be payout ratio. Market cap would be the dividend yield. So it's a portion of your returns that come from dividends. So it varies widely across the world. The US is one of the lowest dividend yields in the world, but it's giving you only a piece of the puzzle, right? But I've also looked at the percentage of companies that buy back stock. The US is the highest at 46% of companies. So this is no longer just tech companies, it's half the market, the companies in the market. In fact, a much higher percentage of US companies pay dividends than buy back stock than pay dividends now, 45.6%. There's the amount returned, more than $1 trillion in cash in 2024, and the percentage of cash return. But the key is, if you look across the rest of the world, that number is not zero anymore. 20 years ago, it would have been the US, not 35% then, and the rest of the world was 0%. You can look at the UK, you can look at Japan. Now, Japan is actually was my biggest surprise here, because the Japanese companies have traditionally been driven by inertia. They're reluctant to change, but even Japanese companies have joined in this process of buying back stock. The parts of the world where it's least seen, Eastern Europe and Russia, no buybacks. You're saying, let's put pressure on Russian companies to buy back stock. Good luck with that, right? So this is tied to the corporate governance component, which corporate governance is weak, you're not going to see it. But India, for instance, less than 10% of cash returned is in the form of buybacks. It's still rare in India. Part of it might still be laws on the books that make it more difficult to buy back stock than dividends. But I'll wager 10 years from now, when you look at these statistics, that more cash across the world is going to be returned in buybacks and dividends, and I think it's a good thing. For me, dividends are the problem, not the buybacks, because they don't fit my version of residual cash flows. So this might be a good time to ask, why did companies start on this fixed dividend policy? Now, how do you get started? It's insane, right? To pay a fixed dividend to investors who get a residual cash flow. What do you think created this process where companies started paying fixed dividends? Must have started somewhere. Somebody may have said, this is a good idea. Which market came first, the bond market or the stock market? In terms of history, which markets were? The bond market predated the stock market. There were bond markets before stock markets existed. People bought bonds for the coupons and the cash flows. When companies like the East India Company issued bonds before, they would borrow money from the public with bonds. So much of the market, investors were used to the bond market. What do you get in the bond market? You bought a bond, you got a fixed coupon. So let's say you're the guy IPOing the entire equity asset class. What do you have to do? You have to get investors who are used to bonds to try to buy stocks, right? You can already see how this is going to play out. How do you make stocks look like bonds? You tell investors they'll pay a dividend. And by the way, we can't contractually guarantee the dividend, but we're going to try to pay at least this amount every year. You can see the start of a rigid dividend policy. People were investing in stocks, collecting dividends like there were coupons, and what did they expect you to do? Continue to pay not just the last dividend, but perhaps a little higher, 2% more every year, because you were getting a coupon with an inflation component built in. The 1800s. And then it got built into how companies paid dividends. And you look at dividends today, they still reflect that history. The problem is, 100 years ago, the kinds of companies that were raising money in capital markets tend to be established companies, railroads, utilities. It was okay paying dividends. And you look at the kinds of companies going public today. A Palantir. In what universe can a Palantir promise a fixed dividend and be able to deliver? Or a DoorDash? The world has become more uncertain, and it's dividends that really have to change. You don't like buybacks? Do special dividends, where essentially dividends are going to reflect what you can afford to pay. Tie them to how you're doing it, because just like you match debt up to the assets, you want to match what you pay out to your shareholders to what you can afford to pay out. So buybacks are not going away. They're just going to get bigger. They're going to go global. You're going to see this phenomenon kind of spread across companies, because no company in its right mind should be going out and saying, we'll pay $2 in dividends this year and increase that by 3% every year for the next 50 years, because you can't have the earnings to back it up. So as the last part of today, let's look at your company. So when you get a chance, I'd like you to take a look at the dividends your company. Let's focus on dividends first, then talk about the buybacks. Where would you find the data on dividends for your company? What financial statement? Go to the statement of cash flows. Under that section on financing cash flows, if there are dividends, there should be dividends paid. In fact, it's the same section. You also see the buybacks, right? Is it possible that your company doesn't pay dividends? In fact, you're the rule, not the exception. Most of the companies in this class, you won't see any dividends. How do I know that? Because most US companies don't pay dividends. But some of your companies will pay dividends, some will pay big dividends. So the question I ask is my company an outlier, given how much it pays in dividends? Dollar dividends can't be compared across companies for obvious reasons. The per share number, who knows what that per share number looks like? So we need to scale dividends to something. One is the dividend yield, and I talked about scaling dividends to your market cap. It's actually a kind of intuitive measure of, hey, this is how much of my return I will get from dividends. If you remember, when we used the capital asset pricing model, expected return plus beta times equity risk feels like a throwback in time. We got a number. For Disney, it was like 9.02%. You're saying, what does that mean? Well, that's my total expected return. Some of it is going to come from dividends, and some of it is going to come from price appreciation. The dividend yield is the portion that comes from dividends. Dividends divided by the market price. But I could also divide dividends by net income. Why? Because at least in theory, earnings are what you have to pay out. I know it's not a cash flow. Dividends divided by net income is called the payout ratio. So would you like a high payout ratio or low payout ratio? It's not a question of like. It's a question of, if I have a high payout ratio, I'm paying most of my earnings out as dividends. That's good in terms of cash for me as an investor, but it's bad because a lesser percentage is being reinvested. So I have to accept the fact that companies that have high payout ratios are probably going to have low growth. Dividend payout ratios measure dividends relative to net income. Dividend yields measure dividends relative to market cap. At the start of every year, I actually update these numbers for the market because I want to get a sense of what does the world look like in terms of yields and payout ratios. The first one is dividend yields in January 2025. There's the global distribution of dividend yields of dividend paying companies. So let me be clear about why I'm drawing the distinction. Many companies don't pay dividends. If I bring them to the graph, in this graph, you know what's going to happen? There's going to be a huge spike on zero dividend yields. I don't want them in my, it makes my picture look, no, you might not even see some of the columns if I bring that in. So among dividend paying companies, this is what the distribution looks like. So there are US companies in the dark red and global companies in the bright red. You already saw the dividend yield for a US company, at least across the market, is 1 to 2%. So if your company has a dividend yield of 1 to 2%, it's pretty much in the norm. If your company has a dividend yield of 3.5%, 4%, it's an unusual company. And especially as you get to 4.5%, it becomes a company. Look, I said, this is amazing. I'm going to buy this company. Why the 4.5%? Why did I use that as a trigger? Because that's your T-bond rate, right? You're saying, look, I can invest in a T-bond, get 4.5%, or I can buy the stock and get a 4.5%. Seems like a no-brainer, right? Just buy the stock because now you get the same return you'd have got in a T-bond, plus you get price appreciation. This is Ben Graham value investing. Because that's effectively that entire book of security analysis you can boil down to, I want to buy a stock where I can collect enough cash flow each year that covers what I could have made by buying a bond, plus I get the price appreciation. In fact, there are entire investment strategies built around buying high dividend stocks, 5%, 6%, 7%. So you can see there are companies out there with dividend yields that exceed 8%. You're saying, are these companies? I mean, this looks like a no, you know. So if I loaded up on those companies with more than 8% dividend yields, I should have a great portfolio, right? What can go wrong? You paid, when you say a dividend yield of 8%,
I can't be doing that.
in fact, it's not even might not. These are companies where there's a disaster. They're like companies driving 80 miles an hour with the driver blindfolded. This is not going to end well, right? Because when the market price is that low, the investor's saying, this company is a basket case. It's continuing to return cash. 8% dividend yields are not sustainable. Something is going to break here. And that's the difference. The T-bond rate, the 4.5% is guaranteed, I think. It's a US Treasury, who knows what that might do. But the 8% dividend yield is the dividend yield from last year. You buy these stocks, the next thing you know, the companies are cutting dividends or going bankrupt on you. But across all companies, you can see the dividend yield varies. There are companies that look like they're deceptively cheap. Deceptively cheap because the price is low, the dividends are high. But I've never been a fan of strategies built around buying high dividend yields unless you've taken a really close look at the companies. And most of those companies, when you look at the companies, and we'll talk about the metrics you can look at, those dividends are unsustainable. But the median dividend yield for all companies is 0%. Why? Because there are more companies that don't pay dividends than don't. These are just the dividend paying companies. Let's look at the payout ratio. Here again, remember, I'm dividing the dividends by the earnings. The ratio is going to be 0% if you pay no dividends. It's going to be 100% if you pay all your earnings out as dividends. But there's this extra column of companies that pay out more than 100%. It's not small. About 15, 16, 17% of companies have payout ratios that exceed 100%. Now, these companies might be crazy, so let's set that aside. But there are rational explanations, good reasons why a company might choose to pay out more than 100% of its earnings as dividends. Wade, do you have any?
Yeah, two that come to my mind.
Okay.
Banks and REITs.
Okay, banks and REITs. So let's take the REITs first. What is it that as a REIT that'll lead you to pay more than 100%?
Qualified REITs have to distribute. I believe it's like greater than 95% of their earnings.
So,
a year in order
but why wouldn't they stop at 100%? So what is it about real estate that allows you to pay out more than 100% of earnings?
they can take out debt.
That's a dangerous reason, right? You borrow money to pay dividends, you're digging a hole.
REITs have a trick where they can apply depreciation to.
Exactly.
They can pay.
It's so they're allowed to add that depreciation component, which means you can get above your earnings. But it does mean that for REITs to grow now, you have to issue fresh equity, right? It comes with that catch, right? So REITs, why banks?
Banks, even in down years, a lot of them.
But let's focus on in down years, you pay out more than 100%, hoping what happens? That they have up years. So in up years, you should be paying well below. So you're paying based on normalized income. So any company with a lot of cyclicality in earnings, during bad years, you might pay out more than 100% of earnings, not because that's what you plan to do forever, but because you think the earnings are going to bounce back and that you use the good years to buffer the bad years. So it could be. So not just banks, but and so REITs, it could be cyclical companies. Any other ideas in companies that should be paying out more than 100%? It's actually rational. You remember the corporate life cycle that I introduced at the start of the class, that companies grow, then they mature, and then they enter into a phase where what should they do logically? They should shrink, right? How does a company shrink? You divest assets, you take the cash flows, and you return them, right? You can do them as buybacks, but you could also pay dividends. If you have a company whose business has turned bad, it's not going to grow. It's a tobacco company, right? What exactly are you reinvesting in? Fewer people are smoking, the business gets smaller. You might be liquidating yourself partially every year because that's what paying out more than 100% of your earnings does. It shrinks your equity, shrinks your company. So there are crazy reasons for paying out more than 100% of earnings. You do it because everybody does it. You do it because you hope to borrow money, and it's a but you don't do it consistently for those reasons. If you want to do it consistently, either because you're in a bad business, you're shrinking, you're a volatile business, you expect earnings to come back. The danger, though, is if earnings don't come back, then you eventually have to return to those dividends and say, I can't pay this anymore. Or it could be because there's a quirk in the tax law, which is what the REITs do, which allows you to pay out more than 100% of earnings as dividends. And REITs have another advantage, which is in addition to this depreciation effect, they don't pay taxes on their earnings, right? So it's pre-tax income, it essentially gets returned. And the IRS is hoping to tax you on your dividends. So the IRS is happy when more than 100% of earnings is returned as dividends, right? Unless they get returned as dividends to tax-exempt institutions, because then it kind of flows into the space where it doesn't get taxed at any level, not at the corporate level, not at the investor level. So what I would suggest you look at is look at your dividend yield and payout ratio for your companies very quickly. You can do it in 2 minutes. See what your company pays out in dividends. So next session, we're going to talk about the trade-off that drives dividends, but it'll be after the quiz. So I'll talk to you on Wednesday. I will have office hours this Sunday, so I'll send you again those 2 hours. So if you have questions.
How you doing? Congratulations on the soon to be. Third.
Then it was an event for me. My grandson lost his first 2 baby feet. He's 7 years old. My granddaughter had a birthday on Wednesday.
With that being said, rumor has it that you won't be here next year, and I don't know if that's a rumor. Yeah, it makes sense. Anymore? Or next year?
I'll be back again.
But you're gonna stay on Tuesday, next week, right?
No. You just,
I've got all 2025 and spring 2026. I'll be back.
back with a vengeance? Back with a vengeance?
Back with the vengeance.
Oh, I just wanted to double check on that. Well, thank you.